Stocks moving lower this morning as investors await two big tests for the markets tomorrow, CPI and the Fed decision. Even with fears around higher for longer rates, strategists broadly expect big tech to lead stocks higher through year end, driven by AI demand. Our next guest is one of those strategists. We have Abby Yoder, JPMorgan Private Bank US Equities. Abby, thank you so much for joining us in studio. And you have a pretty bullish outlook here. 5,500 year-end price target for the S&P. You see that going up to 5,750 next year. What's driving that?
So I think importantly, when we're thinking about the breakdown of returns, right, that's earnings and multiple. When we're thinking about both the 5,500 and that 5,700, that's all coming from earnings growth. And that's between 8 to 10%, depending on what calendar year you're looking at. And the majority of that is being driven by tech, right? And what we saw in Q1 was this really, just strong across the board quarter in terms of earnings. We saw all 11 sectors beat in Q1, but a lot of that strength was driven by tech. And in particular, we saw their margins expand. And so that's very important to us when we're thinking about, 60% of costs are fixed. How do you see that incremental uptick in terms of earnings growth? We're seeing that from tech in terms of their margin profile. And then on the valuation front, we actually have valuations contracting a little bit. And that again is also being driven by tech. And when you think about it from a natural standpoint, their prices are high and their valuations higher than the market at the moment, but they're going to grow into that valuation, right, through their earnings growth, so then you naturally see that valuation compress from a large cap tech perspective.
And that seems like a critical part of why you're able to make the tech sort of rally, but also inherent concentration within tech part of your bull case when we have a lot of other guests come on and say that the concentration of the rally in tech is a bearish signal for them. How are you thinking about the differentiation there?
Well, so there are two things that I would point out. One, the concentration is being supported by the earnings, right? Yeah. So you're seeing not only the concentration from a market cap perspective, but you're seeing it from an earnings because they continue to outgrow the rest of the market. Now, coming into the year, we really were thinking that there was going to be this broadening out in terms of the equity market performance into the year end, and we still do believe that. But what you're seeing is that was predicated on the growth rate differentials getting narrower, right? And so what we've seen is we're still seeing that narrow as the rest of the, let's call it 493, 494, catch up to the rest of the Mag 7. But what you're seeing is the tech growth rate is staying elevated, right? So that saw a little bit of an uptick in 1Q. So it's still driving the market in mid-teens EPS growth through the end of the year, but you are starting to see, as other sectors come out of their rolling earnings recession, you're seeing their earnings growth also pick up. So a little bit of a broadening out, just not to the same magnitude.
When do you expect, if at all, we're going to see that same magnitude of broadening out, and what sectors do you think could benefit from that?
So that would be like a second half phenomenon. And I think for us, when we're thinking about it, so we're overweight 4 sectors. We're overweight technology, consumer discretionary, healthcare, and industrials. And I would say at the forefront of really coming out of that earnings recession is healthcare. Healthcare saw their first negative annual earnings growth period last year in 2023. There was a lot of COVID digestion going on across different parts of that sector. And they're about to flip from negative, so they had a negative 1Q or year-over-year earnings growth rate, and that's going to flip positive as we go through the back half of the year. So you pair that with really attractive valuations in the sector, and that to us is a pretty nice setup in terms of healthcare.
I was talking to a source about the healthcare sector yesterday too, who mentioned that their ability to kind of navigate the higher for longer environment is a differentiating factor as well, and the ability to not have as capital intensive sort of expenditures on the balance sheet. How much of that is a line of thinking and an investment thesis that our investors listening to this should be really looking at in this higher for longer environment? Does that apply to other sectors as well?
Yeah, for healthcare, they're not as dependent on the interest rate environment when you're thinking about large caps, right? Let's be very clear. Small cap biotech is a totally different story. It's riskier. It's much more, I would say, exposed to higher interest rates and will be challenged in that environment. But yes, from an overall large cap healthcare perspective, it's defensive. It typically, again, usually has positive earnings growth, and we didn't see that last year. So I think that's a nice differential as well. Industrials is something that we would think would actually benefit from a higher for longer rate environment, right? When you think about the cyclicality of that, we're seeing PMIs, what we think is bottoming, and then you've got structural tailwinds around things like AI. So that's another sector that we do like, interest rate agnostic as relates to industrials.
And speaking of higher for longer, we'll have updated economic projections from the Fed tomorrow. If we see less cuts cuts projected by the Fed. Is that a risk to the market? What if the Fed doesn't cut at all?
Yeah, I mean, look, I think the risk as it relates to the Fed is not necessarily whether or not they cut at all. Right now, we actually only have one cut penciled in at the end of the year. It's really like, what is the next move and what signal does that send to the market? And I think if the next move were all of a sudden to become a hike, then that is a totally different story when it comes to equities. But as of right now, we are still of the base case that we are going to see inflation gradually come down, which is going to lead to that cut. It just seems like it's going to be later than what was originally anticipated in the beginning of the year. And I think the question is really getting at, okay, what does that mean in terms of valuations? How can we continue to defend these valuations? And I think it's a really, and I think this is where the equity risk premium conversation comes in as it relates to equities. So how do equities look relative to bonds? And if you look in the past 15 years, they look really expensive on an equity risk premium standpoint. But if you extend that out to a period before the global financial crisis and interest rates weren't zero, the equity risk premium was more compressed, similar to how it is today. And so if you're thinking about the risk of inflation remains elevated, but the risk of recession feels relatively low, I think in that tug of war of arguments, I think equities win in terms of relative to fixed income.
Zooming ahead to Friday, Abby, when we're all heading to our Friday evening happy hour to talk about financial markets, as we do, what will you say was the single biggest driver of the week? Will it be the macro news, CPI, the Fed, or a lot of the tech headlines that we're getting from Apple, from Tesla, and as always, NVIDIA as well?
I think we're in a little bit more of a macro vacuum, let's call it, till we start earnings season again back in mid-July, right? Like, I think a lot of the rally that we saw when the market bottomed on April 19th through, end of May and now was really earnings driven. I think it was fundamentally driven. I think, yes, there were definitely some tailwinds as it relates to from a macro standpoint, from a softer inflation print that the market really needed. But I think right now it's going to be more macro driven than micro at the moment.
Abby Yoder, JPMorgan, private bank U.S. equity strategist. Thank you so much for joining us today.